in the group accounts, you've got a 40% investment. And I wonder how many different ways there are, potentially, for accounting for that 40% investment. My name is Tom Clendon, and I help ACCA students pass their SBR examination. And this podcast is going to, I hope, educate you, illuminate you into the number of different ways that you can actually account for a 40% investment in the group accounts. First up, let's deal with the rebuttable presumption. If you simply tell me, and no more, that we've got a 40% investment, the rebuttable assumption is that it's an associate, that we have significant influence over that entity's operating and financial policies. And therefore, because it's an associate, we're going to use equity accounting. Now, ideally, I would like further information other than just the 40% holding to confirm and validate that judgment. For example, if it is that we have significant influence, I would expect there to be board representation. So if the company's got 3 directors, I've got 1. If the company's got 5 directors, I've got 2. Representation on the board, because that's where the decisions are being made. I would also expect, although it's perhaps slightly less important, evidence that we're doing some trading with that company, or maybe there's some common staff exchange or staff trading, whatever. Now, having reached the conclusion that it's an associate, equity accounting applies. Single line accounting. A single line in the statement of financial position, in the group profit and loss account, and in the group cash flow. In the group statement of financial position, basically, you've got a non-current asset, investment in the associate. And that will go up each year by the share of the retained profits. The share of the retained profits, and any gains that you retain, or the share of any gains that you retain that have gone through equity, through other comprehensive income, and therefore through other components of equity. So the investment will rise each year by the share of the retained good news, the profits generated by the associate. One line. In the group P&L, no revenue, no cost of sales for the associate. Equity accounting means that you have the share of profit. One line. Share of profit. Okay? Income from the associate. You take the share of the associate's profit after tax. One line in the group P&L. And in the cash flow, well, your cash flow year on year with the associate will be the dividend that you receive. Okay? So the dividend received will be a positive cash flow. It's an inflow for the group. Operating, investing, and financing, it's investing. It's a return on your investing activities, so it's under investing activities. And of course, the dividend you receive is different figure from the share of profit. Okay? Because they may make a profit of 10, but we only receive 4. And therefore, the cash flow shows investing activities positive 4. The P&L will show share of profit 10, but the net retained earnings has only been 6. So the balance sheet, the investment in the balance sheet only goes up by 6 in the group statement of financial position. The default, if you own 40%, the default is associate equity accounting. But this is SBR. And so we have to be alive to the reality. We have to read the question, and it is possible that a 40% investment is a sub. It is, because the definition of a sub is not based on the percentage that we own. The definition of a sub is based on the substance, the principle of whether or not we control it. PEA. Do we have the power? Do we have the exposure? Do we have the ability Do we have the power to direct the operating and financial activities? Do we have exposure to the variable returns? And do we have the ability to exercise that power? And if we're going to turn over the rebuttable assumption that it's an associate, the question needs to give us some more information. The question, for example, would need to tell us something about the size and the disposition of the other shareholdings. Let me give you an extreme example. We own 40%. Well, what about the other 60% shareholders? Maybe they are 60 equal individual shareholders who all own 1%, and those investors are totally unconnected, never seem to turn up to shareholders' meetings, don't participate in any way, shape or form. We therefore will always dominate in that scenario. Let me give you another example where we would have the power is if there are potential voting rights, if we hold potential voting rights. So, for example, options or warrants that could give us an additional 20, 30% of the shares if we exercise them. And we might exercise them because maybe those options are current. They could be exercised today. Maybe those options are in the money. So we would have the ability to buy the share at an option of $5 when the share price was $6. That would be real. That would, even if we hadn't exercised the option, the existence of those options would give us the power because people could realize, would appreciate that we could exercise it. They wouldn't want to cross us. They would go along with our decisions. But here's where it gets a little bit complicated, because if the options are not in the money, if the current share price is $10, but we've got the option to buy the shares for $35, well, we're not going to do that. It would be mad. And so you wouldn't really take that into account. The same as if the options were not exercisable for a generation, for 2, 3, 5 years ahead, it wouldn't necessarily affect the reality of today's ground. You've got to consider the substance. It's even possible in a discussion question at SBR, there isn't an absolutely 100% definitive answer. You're discussing it. You're explaining it. You're exploring the possibilities. But if it is something that you control, then we have to reflect substance. We have to faithfully represent the fact that we control this entity with a 40% holding. And therefore it would be a sub. So you'd calculate goodwill. There'd be a line-by-line acquisition. There'd be a line-by-line consolidation. Each asset, each liability, each income, each expenditure of the sub would be aggregated. There'd be fair value adjustments at the date of acquisition. And bizarrely, there'd be an NCI. And because you only have a 40% interest in the profits, the NCI would actually be a 60%. 2 down, 2 to go. Because actually there are 4 different ways of potentially accounting for a 40% investment in the group accounts. Associate, obvious. Sub, possible. The third one is it a joint venture? Now, for it to be a joint venture, there has to be an agreement between one or more parties that means that the parties have got control over that entity. So decisions are made between the parties on a unanimous basis. Important decisions are made between the venturers, on a unanimous basis. So if somebody has a right of veto, if somebody can vote against it, then the decision doesn't happen. So the classic, simplest example is 50-50. I own 50% of the shares, you own 50% of the shares. And so if we want a decision made, we both have to agree. But remember, this is SBR. So it may not be that simple that it's a 50-50. And remember that we only own 40%. So we could have another shareholder, let's say another shareholder with 25%, with whom we have an agreement. And the agreement could be that we make decisions together. We make decisions when there is a threshold of 65%. And providing the other shareholders are all small and unconnected, the two of us are in control of that company because we've got the two blocks of shares. And therefore, it becomes a joint arrangement. We've got joint control. It's an incorporated entity. So we've got the right to the net assets, not responsibility for individual assets and responsibility for obligations. So it's not a joint operation, and therefore it's a joint venture. And therefore, because it's a joint venture, it's equity accounting. And I've already explained how equity accounting works. Bottom line, associates and joint ventures are accounted for in the same way. Equity accounting, single line. So what's the fourth? The fourth is that you own 40% of the shares, but you have no control. You have no influence whatsoever. You're not sharing control. You have no say. And how could this happen? Maybe, although you own 40%, your enemy owns 60%. It's somebody else's sub and they won't let you on the board. It's somebody else's sub and you have no participation or influence whatsoever in the way that company is run. And therefore, what you're left with is a financial asset. What you're left with, IFRS 9, what you're left with is a financial asset which will be an equity investment, which therefore must be accounted for at fair value. And if it must be accounted for at fair value, you then have to consider where the gains and losses go, and the default will be fair value through P&L, although you can make, under IFRS 9, an irrevocable election for that investment to be accounted for at fair value through OCI. Oh my God, I've exceeded my 10 minutes. All right. But look, thank you for listening. Please like, please subscribe. My name is Tom Clendon. And whether it's a podcast, whether it's on YouTube, whether it's on LinkedIn, I am here to help students pass SBR. I provide online courses, and if you want a comprehensive online course with a pass assurance, with a payment plan, with my support, marking, just get in touch. Please, just get in touch. Reach out to me. All right. Thank you very much for listening. Enjoy. Spread the love. Take it easy. All the best.